Good afternoon, everyone. This is Soni Patnaik. Welcome to HDFC Securities Derivative Webinar Series 3 on Derivative. In this session, we would be covering hedging through derivative. So let us understand why derivative is important when it comes to hedging. What is hedging? How can we hedge our positions? When would be the right time for us to get into a hedging kind of a position? How to understand what a portfolio looks through, how the hedging is to be done. So everything is what we're going to cover in this session. So on a first slide, we'll first understand what hedging is all about. So in a very layman term, hedging means it is nothing but the insurance. In very layman term, it means that it's an insurance where we are protecting ourselves from any kind of a negative event or any kind of an offsetting position that we're going to take. So what happens is that tomorrow, as we know, the market is always uncertain, where we don't know what may happen tomorrow. If it's going to go up, if the price of a particular stock is going to go up or go down, we would never come to know. So in this case, to protect ourselves or to protect the risk of such positions, we need to take an insurance. So this insurance is what we call as hedging in derivative terms. So hedging is nothing but, as you can see over here, it is used to reduce the risk of adverse price movement in an asset class by taking an offsetting position in a related asset. So first, before we understand how to get into what kind of hedging needs to be done, we need to understand what our portfolio actually looks like before we get into the details of hedging. Now this portfolio, we need to understand whether it's how it looks like on a beta weighted or a delta weighted basis. So this session is all about understanding how this hedging is done through beta hedging, delta hedging, what beta stands for, what delta stands for, and how the hedging is done through these terms. So this is what we are covering in an entirely for this session. And also we need to understand whether whether a portfolio has a extremely bullish angle or a lopsided angle, or it is actually on both sides. So this is very important for us to understand what a portfolio or what weightage do we give in a portfolio before we understand what kind of hedging we need to go for. So we would be covering some basic strategies. We would be understanding what beta hedging is. We would be understanding what delta hedging is. And we would also be covering what kind of strategies, a few strategy examples. That could be like covered strategies, spread hedging, and so on. Moving on to the next slide, first we'll understand the factors that influence hedging decisions. Could be a lot of factors, but what currently we are going to focus right now is on understanding the beta and delta. Very two important factors, very two important Greeks to understand before we get into the details of hedging. Beta is nothing but the systematic risk measurement of a portfolio or a security in comparison to the market. So when I say a stock has a beta of so and so, something of so and so percentage, it means that theoretically it compares how much volatile it is in comparison to the market, that particular stock. So every stock has a different beta level. Every stock has a variant beta level. So when I say a beta is less than 1 of any particular stock or security, it means that theoretically it is less volatile than the market. If a beta of the stock is more than 1, then we say that it is theoretically more volatile than the market. So for example, if a particular stock has a beta of 1.2, we say that theoretically it is 20% more volatile in comparison to the market. So this is what beta stands. Now beta varies for all these stocks. Some may be less than 1, some may be more than 1 as well. Now delta on the other hand would measure what my price is to be of an option if my stock moves by 1 point. This is what delta measures. It is the degree to which an option is exposed to shifts in the price of the underlying asset. So if my stock is moving by 1 rupee 1 point, how much should my options become? My price of the options should be by that particular movement. And this movement is what is measured by the delta over here. So this is the basic understanding of beta and delta. To get the beta values, it is readily available in NSE site. You can just visit nseindia.com to get all the beta values of all these stocks. Whereas of delta, if you want to understand where to find the delta values, you can find it from a pro terminal. Moving on to the next slide. Here is a screenshot that we have taken from a pro terminal where you can find the delta value. As you can see, there are two yellow arrows. One is pointing upwards towards known as your option calculator. So if you click on that option calculator, you would be prompted to this kind of a window where you would have to, just select which symbol or which script that you're going for. Over here in this example, I have just selected a Nifty series, Nifty 20th June series, and you have to select which strike you're looking for, because delta for all futures is usually around 1, but delta for all these strikes will always differ. So you just have to enter the strike price under that strike column and hit enter. Once you've submitted it, it will give you the entire value. So the yellow arrow that you can see that is pointing to the left side, that's where the delta comes out. Now here for this 11,000 call of Nifty June, at that particular date, you could see that the delta is 0.26. All the call options will have a positive delta. It means that they have positive correlation to the index, whereas all the put options will have a negative delta, whereas they have a negative correlation to the underlying asset. So this is where you can find delta. And for beta, we can visit nseindia.com to get the beta values of all these stocks. So now we have covered what beta meaning is, what delta meaning is. Now we'll understand what is the difference when we go for beta hedging or a delta kind of a hedging. Moving on to the next slide. Here is a difference, a brief difference, what we understand between beta hedging and delta hedging. So beta hedging means that if I say an investor is heavily invested, for example, in technology stocks, and the portfolio of his entire, the portfolio beta of his entire portfolio, let's say, is +4. So it means that theoretically his portfolio is 400% more volatile than the market. Now to neutralize this portfolio or to make it as a beta neutral portfolio, he would have to purchase stocks with some negative betas. Negative betas usually mean where these stocks would perform better if the market comes down. This is what negative beta means. So if someone's portfolio, if this investor's portfolio is heavily invested in technology stocks with a positive beta of 4, and the market moves up, then only this entire stock that he has in his portfolio would actually be more volatile to the market. But if the market comes down, this investor would be equally affected by that volatility or by that downside movement. So in that case, he must take an offsetting position, and that offsetting position for beta hedging would be to take or purchase stocks with negative beta to reduce his overall market risk. So this is what beta hedging means. Whereas delta hedging, it actually involves the calculation of the delta of the overall portfolio, derivative portfolio, and then taking offsetting position in underlying assets to make the portfolio delta neutral or zero delta. Delta neutral or zero delta means that the portfolio is neither positive delta or neither negative delta. If it's a positive delta, then the portfolio will give you positive returns when the market is moving up. But if the delta is negative delta and the market is moving up, then you would be seeing some negative returns. So this is what delta neutral or positive delta, negative delta actually means. Now in this example, if the investor's position has a delta of +40 in one particular stock called ABC, it means that if the ABC stock is moving by 1 point, the option in this particular stock of ABC will move by 0.40 points. This is how delta is calculated. So if I say that tomorrow the stock is going to move by 1 point, my stock option will move by 0.40. Now this obviously is particular only to this stock option that has a delta of 0.40. So all stock options, all the strikes will have different delta. So this is how delta hedging is to be done. Now if this investor has to neutralize his portfolio, then he has to take a position by offsetting by taking the position of a negative delta, -40 delta. So this is the difference between beta hedging and delta hedging. Beta hedging is usually done with futures, more specifically index futures, Whereas delta hedging is done through options only. Could be stock options, could be index options as well. So this is the key difference between beta hedging and delta hedging. Moving on to the next slide. Here's an example where we'll understand exactly what beta hedging is all about. So I have 5 stocks in my portfolio, particular stocks like ABC, DEF, XYZ, PQR, STB, random stocks. Now the stock value that you can see against each stock, like against ABC you can see 4.5 lakh, against DEF it's a 5.5 lakh. So these are the investment values of these stocks. So the total portfolio value of all these 5 stocks comes out to be 20. This entire portfolio is 1.2622. It means that this portfolio is going to be 26% more volatile than the market. Now, how to hedge your positions in this kind of a portfolio? So we have the weighted beta with us, we have the total portfolio with us. So you need to short futures to probably index futures to hedge your position. But how to find out what exactly would be the amount, or how many lots should I go for selling index futures to hedge this portfolio? This calculation is done by multiplying your weighted beta into the total portfolio of the stock. So it is 22.3 lakhs multiplied with 1.26. It comes out to be 28.14 lakhs. So this is the value of the futures you need to short. But obviously this is the amount. We need to find out the exact lots of how many lots should we sell in the index futures so that our portfolios remains hedged against this. Now the contract value over here is 8.3. So contract value is nothing but the multiplication of the current market price, multiply it with the lot size. So if I say index futures has a lot size of 75, for example, and the current market price is 11,000 something. So if you multiply 11,000 into 75, it comes out to be 8 lakh something. So here the contract value is similar as 8.3 lakhs. So for the perfect hedging, you need to sell 28.14 lakhs divided by 8.3 lakh, which comes out to be 3.39 lots. But obviously we cannot go it in fraction selling. So we can either sell 3 lots of index future or 4 lots of index future to hedge this position. So what happens once you've hedged this kind of a position? If tomorrow the market goes up, you would be getting some positive gains out of all these stocks that you have invested in in your portfolio that you have right now. But tomorrow if the market comes down, your portfolio is also bound to witness some kind of erosion because of the negativity in the market. But because you have index futures or sold against your portfolio, so that can show you some profit. So your entire loss that you're seeing because the market has come down due to the due to the downfall and your portfolio has eroded. But in this case, when you have sold index futures, you can see some profits coming out of that. So your overall risk or your overall loss is negated or offset or reduced. So this is how beta hedging is actually done. And this is the simple way to understand beta hedging. But very important to remember that to calculate beta hedging of mid cap or small cap stocks is very difficult, because mid cap and more small cap stocks are highly volatile. So the calculation of stocks in mid cap and for small cap stocks in the portfolio would be quite volatile in those cases. Now moving on to the next slide. Now here we would be understanding exactly how different kinds of hedging is to be done. So beta hedging is already done. Now we would be coming into the next kind of hedging. Some basic strategies of how we would go about hedging when it comes to delta kind of hedging. Now delta is basically for the options hedging. Now because it is related to the options, so there can be various strategies that one can do. In this kind of hedging strategy, we can easily go for something very simple called as vanilla hedging. It means that you just buy naked options against your portfolio, maybe index options, or maybe each individual stock you buy some stock options against those individual stock in your portfolio to hedge your position or take a contract trade against your portfolio view. So this is a simple vanilla kind of a hedging. Covered strategies would be the next kind of hedging, where you have some stocks when you have a portfolio and you start writing options, deep OTM options, so that it becomes a covered trade for you. Obviously, this is called as a covered call strategy. When you sell call options against your portfolio, in that particular stock, against each stock you sell a call option, a deep out of the money call option. This becomes as a covered call strategy. And the third kind of hedging strategy, known as your spread hedging, it has various kind of hedging, known as bull call spread, a bear call spread, a bull put spread, and a bear put spread. We have covered few of these strategies in the further slides. We would be explaining spread hedging a little in details. But before that, it's just let us remember one important point. Just because one, we have a portfolio, it is important for us to hedge against those, unseen volatility, unseen negative news in the market. But very important to understand is that we must always remain hedged. Tomorrow, even if we are taking a new position in the market, that is also important for us to hedge those positions, because just because it's a new trade, it does not mean that it does not qualify for not being hedged. So if you're taking a fresh position tomorrow and you are seeing that the market could be quite volatile, or you don't want to take so much of risk, you can still hedge your position to offset or reduce that risk in your fresh trade. Now, what happens in this kind of a strategy? We call it as a protective put strategy. So this is where we entail buying ATM put options to reduce the risk in the trade. So if the stock is moving up and your put option is coming down because you bought it, but because your stock moves at a higher speed than your put option will fall, you would get a marginal good profit. But just imagine if you're not hedged properly and tomorrow you've taken a fresh position and the market suddenly comes up to some kind of negative event and it starts to fall. So in this case, maybe if you're not following a stop loss, a disciplined trading system is not being followed, it can result in unlimited losses. Because it results in unlimited losses, it can increase your risk also. So to reduce this risk and to not take that kind of a major risk factor when the markets fall because of some sudden news, we can hedge our positions by buying a put option. So this kind of strategy is called an protective put strategy, which I have explained in the next slide. So we'll move on to the next slide. Here it is a protective put strategy. So it is nothing but a strategy which is usually employed when the trader is still bullish on the particular stock, but he is wary of some kind of uncertainties in the near term. So maybe there is some negative news, or maybe the market suddenly falls, or maybe there are some volatility movement coming in that particular stock. So instead of just going through that kind of a tensed moment, the trader can go for a protective put strategy. For example, if the investor has purchased 100 shares of the ABC stock at 10 rupees per share and the price has increased to 20 rupees, but the trader has still not squared off his entire position. So to ensure that he doesn't lose this unrealized gain of 10 rupees, he can purchase a put option of the same stock that will protect him for as long as the option contract is in force and as long as he holds this ABC 100 shares in his position and he's not squared it off. He needs to continuously keep hedging. So assume that the investor has purchased the put option with strike price of 15 for 75 paise. So therefore the investor's maximum loss is only limited to 575 because it is the maximum loss because you have purchased this put option, so that becomes your maximum loss. So instead of losing 1000 rupees, if the stock falls, it can go into more negative. So instead of losing this entire 1000, we have reduced this position, we have reduced this risk factor by almost a 50%, and it comes down to 575 because it's protected. So this strategy helps you to reduce that kind of a loss. So the maximum loss is only limited to the premium that you have paid for the put option, whereas the maximum gain is uncapped as the underlying price or the underlying instrument rises. So if this underlying instrument, that is ABC, it goes to 50 rupees, your maximum profit can keep on rising till it goes to 50, 60. Whereas your put option 75% will only expire worthless and turn into zero ultimately. So that your maximum loss of that put option premium that you have paid for is covered, your price or your profit for this particular stock starts to move. So this is how a protective put hedge strategy is done. It is very important. It can save you through some minimal losses, some immediate risk also that you can see in that particular stock. So this is one kind of a strategy. Moving on to the next slide, we have covered some important spread hedging strategies. The first kind of spread hedge strategy, we are going to focus over here on something called a bull call spread. So bull call spread kind of a strategy is done when you have a bullish view, a moderately bullish view on a particular stock or the index or any stock that you're taking a position. So in this case, you want to, just purchase some options, or you probably want to trade in the stock itself, but you are scared that it may fall down tomorrow and you don't want to take much of the risk. So in this case, you can do a spread hedging strategy, which is over here called as a bull call spread. As we remember, like we covered in the first webinar series, we have two options, call and put option. And if we have a bullish view, we buy a call option. If we have a bearish view, we buy a put option. So in this case, what happens is that we can simply go for a buying of a call option as well to trade in this view that we're holding for this particular stock. But instead of giving the entire premium or risking the entire premium turning into zero, we can reduce this risk by selling a higher strike call option. So for this kind of a strategy is done where you buy a call option of the lower strike and you sell a call option of the higher strike. So what happens is that when you're buying the call option, you're paying the premium and you've sold a higher strike call option, so you have received some premium. So there is some premium that in the net credits to your strategy, to your account. So in this case, your profit is limited to the difference between the strike minus both the net premium cost, whereas your loss is also reduced significantly. So what happened is that at expiry, you can see that your profit will keep on rising, but after a certain point, the difference between both your strike prices, maybe whatever is the difference, maybe a 10-point difference or a 100-point difference between both the strike prices, that maximum difference becomes your total profit. And if you subtract the premiums cost, that becomes your total profit into the lot size, that becomes your maximum loss. So the maximum profit, sorry. So maximum profit will occur when the underlying rises to the level of the highest strike that you've sold, or above or beyond that particular strike. But the loss will only be limited to any initial net premium that you have paid. So your strike that you bought A minus the strike that you have sold. So whatever is the total, that premium that comes out to be, that is your maximum loss that you can incur this strategy. So even if the stock falls to like drastically by 10%, 20%, your loss still remains fixed to that premium cost only. So this is important. So this is how a bull call spread strategy is done. Your break even is calculated as the purchased call option strike price, that is just the strike that you have bought A, plus the net premiums that you have paid. So net premium paid would always be a premium paid minus the premium received. So it is your buying call option premium paid minus the selling call option premium that you have received. So if you subtract that premium, you get as your net premium paid, and this becomes and if you have to add this to your purchased call option strike price, that becomes your break-even point. The moment the stock rises beyond that level, your profit starts to come in and it stays fixed. So this is the importance of a bull call spread kind of a strategy. Moving on to the next slide, we have this is the opposite view of the previous strategy. The previous strategy had a bullish view. This strategy has a bearish view. But the calculation, the risk reward ratio remains the same for this kind of a strategy. So in this case, we buy a put option of a higher strike and we sell a put option of the lower strike. So it's the opposite. And because we are buying a put option, we have a bearish view or a moderately bearish view. So in this case, when we're expecting the stock to go down, but we do not want to take the entire premium risk, so we sell another lower strike put option to reduce that risk that we're carrying in all the premium. So in this case, if the stock moves significantly up, your profit, your loss would remain fixed. But if your stock starts to fall beyond a certain point after your break-even point, the profit also remains fixed. So what happens, how to calculate over here the break-even? It would be the purchased put option strike price that we have of the lowest strike, obviously, minus the net premium paid. In the previous strategy, we were adding it. In this strategy, we are subtracting the premiums. Net premium paid calculation still remains the same. It is as premium paid minus the premium received or premium sold, that you can say. And you have to subtract this net premium paid against the purchased put option strike that you have. And over here, the purchased put option strike is the lower strike, and the one that you have, the higher strike, and the strike that you are selling is of the lower strike. So once beyond this BP or the break-even point, the stock moves, your profit remains fixed, and that profit is the difference between the two strike prices difference plus your net premium cost that you have. So this is how a spread hedging in a bear put spread strategy is done. So both these strategies have fixed loss, fixed profit kind of a risk reward ratio. They also reduce your risk factor. Instead of giving the entire premium and risking it to turn to zero when you hit the expiry. Instead of that, you are hedging your position by taking a counter position, by taking a counter trade in a higher or a lower strike price, where you are receiving some premium, and this is going to reduce your loss. So these are three important kind of delta kind of strategies that you can apply for. You can go for a protective put strategy that we covered, or a spread hedging kind of a strategy. It can be a bear put strategy, a bull call strategy. It can also be a bull put kind of a strategy, or a bear call kind of a spread strategy. So these are the kinds of a few examples of the delta hedging strategies and beta hedging. So this is very important. We'll always remember the importance of hedging, why hedging is to be done, where we just want to reduce the risk factor. So this is how few examples, few strategies that we can go forward by doing these spreads. Moving on to the next slide. You can see this is a screenshot I've taken from our pro terminal, where if you want to understand some kind of strategy to be done, you can just go against and click on the left hand side. You can see there are many tab options. There's overview, market, indices, strategies, and option calculator. Just click on these strategies and this window pops up in front of you. So whichever stock you want, you select that particular stock and you click on that strategy. The strategy input window opens in front of you. Now whatever view you're holding, maybe a long view or a short view on that particular stock, you just have to input or write down the target price against the target price column, where you can see the first yellow arrow mark pointing downwards. So if you just give a target of, maybe for this example, hypothetically for this example, Nifty has been set as a target of 10,950. So in this case, once you've written the 10,950, click here for strategies, click on there, the second yellow arrow that you can see. So once you click on that, you would have a set of strategies. Now some strategies can be, some strategies can come as like maximum on number of 2, 3, 4, 5 strategies. Some stocks will just give you 1, 2 strategies, depending on your view and the risk reward ratio. Now there, in this case, we can see there's a long call butterfly strategy, a long call counter strategy. Some strategies are plain vanilla strategies. Some strategies are hedging kind of strategies that we just covered. So this is one example that we can, this is one way the way we can understand different kind of strategies. Obviously, there are a lot of strategies to understand. So we've just covered a few of them over here. Okay, so moving on to the next slide. Again, we'll cover some important things to do and some important things what not to do. We must always work on official research recommendations and ignore any anonymous tips that we get. We must never work on something without a research consultation. We must always identify a risk reward ratio. It could be when you're taking a fresh trade, it can also be when you're doing a hedging kind of a strategy or anything, but we must always define our risk reward ratio. We must not take high risk with unlimited reward, but unlimited kind of a loss. So we know that hedging has its own merits, but it always has to be well sought out. Because hedging is a little difficult to understand at first, but we must always know that it has its own merits and we must always stay hedged. So it is best to seek advice from any experienced research consultant before taking what kind of hedging should you go for. Should it be a beta hedging? Should it be a delta hedging? Even if it's a delta hedging, what exactly kind of strategy should you go for? Because there are multiple strategies that you can do even if it comes to delta hedging. We've just covered a few. So it is always best to seek advice from any expert research consultant. And we must always remember again, like what I've already covered during the beta hedging, where mid cap and small cap portfolios cannot be hedged very easily because the mid cap and small caps are very heavily volatile in nature, and therefore the calculation is going to be very risky, very difficult when it comes to understanding their beta, because they're so volatile that their beta would be very high when you have to compare it with the beta calculation and do the kind of hedging. So we must always be thorough of this concept of hedging. We must continuously read, understand strategies, read more articles, attend more webinars on hedging strategies to understand exactly what hedging means. We must always stay safe and we must always hedge a position to avoid any unseen volatility and reduce our risk attached to those volatility. So in the next slide, you can see our last webinar, upcoming webinar would be on 20th of June, where we'll help you to understand how to make a trade plan. So this is what we've learned. So we've covered in all the 3 webinars. Today is the 3rd one. So we've covered what exactly the basic understanding of derivative, its market participants. We have covered some important jargons of derivatives, some important parameters and indicators. And today we have covered the importance of hedging and few examples of how to go about this hedging. In the next and a final webinar session, we would help you to understand how to make a trade plan. So tune in on 20th of June at 12, this time 4:30 p.m. where we would be taking you through a next webinar session. Now thank you, and I'm open to the question and answer round. So if you have any questions, please write them down and I'll answer to them. Thank you. Okay, I have the first question from Mr. Gopal, who's asking if there is any correlation between 15 minutes built up and a day built up. I think Mr. Gopal, this goes back to our webinar series 2 where we covered what open interest and what built up actually was referring to. I'll answer this. So see, 15 minutes built up has only to do with the intraday trend of that particular stock. Whereas the end of the day build up has to do with a view holding for maybe the next day or the next coming 2 to 3 trading sessions. So this is the difference between a 15 minutes build up and a day build up. So day build up will tell you in the ultimately end of the day, it will calculate how many buyers and sellers have been formed or have traded in that particular contract. And then the open interest gets calculated on how many contracts are kept open. Whereas a 15 minutes built up does not exactly tell you how many contracts are open, but how many contracts are more of traded. So this is the difference between the 15 minutes and day build up, but there is no exactly correlation. The next question would be, what would be the best time to hedge your portfolio? See, I think the time when to hedge a portfolio I would always recommend that one must always stay hedged in any particular point of time, because we are always uncertain of where the market is going to go. So you do not know tomorrow what would exactly happen. We can always make a preemption, we can always assume, we can always make an analysis, but obviously that can never be 100% surety or a guarantee kind of a thing. So instead of taking such risk where anything can happen, where anything, worldwide news, overnight news can come up. So instead of taking such risk for the next coming session, it's better that we stay hedged always. So you can always reduce your ratio of hedge if you do not want to reduce your profitability by a larger amount. So you can reduce that ratio also. But important is to understand what is hedging and when you must stay hedged. The answer would be always. Okay, the next question is from Mr. Arvind, who's asking how to buy a stock using derivative and are making a trade plan. So Mr. Arvind, this is what we would be covering in our next webinar session of how to make a trade plan, how to infuse all these webinar sessions that we've learned, all these indicators and parameters that we've learned in these webinar sessions, and how using these indicators, these importance, how we can make a trade plan and understand how to buy the stock or trade in a particular stock. So this we will be covering in the next webinar session on 20th of June. Please log into them to understand that. Our next question is again from Mr. Gopal, who's asking what inference can we draw by comparing the fresh figures of fresh contracts and squared up contract at the end of each 15 minutes built up, and how. Mr. Gopal, again, this is the same question that I just answered. It's the difference between your 15 minutes built up and the day built up. Right, so any other question, please type in over here. And if there are more questions, I would be willing to reply to all these questions to your personal mail IDs by getting all the questions. So if you have any of you, you can go back through to this webinar session. You can rewind it again. You can understand, because hedging could be a little complicated, complex concept to understand. So you can rewind it, understand it more, and please feel free to ask us any kind of question. Read more articles, stay hedged and stay safe. Right, so we'll meet you again in the next webinar session. Thank you.